Let's shift the focus back to what's happening as far as markets are concerned. And remember, today it was tensions along the LOC that seemed to have roiled markets a little bit. We've got two guests joining in on the show then to walk us through their market strategies. Amit Shah of IIFL Capital PTE, and we've also got Peerless Mutual Funds Amit Nigam with us. Gentlemen, both of you, thank you so much for waiting by. Let's first Amit, start by, talking to you about the kind of correction that we've seen in mid-cap companies. It's been almost now 3 days of, a southward sail, as it were, for the broader markets. Do you think that we can say that a corrective phase is clearly on in the broader universe?
We have been slightly concerned about the valuation where the markets were trading of late, and we've been maintaining for the previous few months that given the earnings profile that we have for the large cap companies and for a large part of the mid cap space, the valuations at which these companies have been trading were getting to the higher side given their own historical bands. So given that concern, probably as we are seeing that these quarter numbers have not been very good, some amount of profit booking has been happening, and probably that's the reason why we saw the broader space correct larger more than the large cap companies.
In that case, what should the strategy be right now, particularly for people who are very active in the small cap universe, because there are margin calls being triggered today and massive bleeding happening there?
So this valuation concern which I shared with you is extremely short-term perspective on the markets. We are very positive on the equity markets from the medium to long term, and we would advise our investors to actually look at these corrections in the market to come in with lump sum investments. So what happens when the markets become stretched in terms of valuations? We suggest our investors to continue with their SIPs and hold on to the lump sum investment in case they are planning. So such kind of corrections are very welcome opportunities when investors can allocate larger amounts of money at a lower price, and thus achieve dual benefits of having higher allocations to equity and an overall cost of acquisition which is lower than otherwise.
Amit, what about you at the fund level? You are also planning to launch a fund, a new offering in these kind of volatile markets. In fact, markets are giving up. Do you expect decent response, and what are you getting to understand from your clients? What kind of opportunity that they're looking for?
We have launched the Series 2 of Special Opportunities Fund, whose objective is to invest in pre-IPO, anchor and QIB stage investments in the company which are coming up in the market. We recently closed Series 1, where we raised close to $250 million of commitments. Our belief is that at the current juncture, when we are seeing so much of liquidity, both domestic and potential offshore, flowing into Indian markets, and with great stability both on the currency side as well as on the market side, our belief is that there will be a lot of good quality companies which will be coming out and hitting the markets. Anyway, there has been a pent up demand for the last 5 years because of the volatility. So if you look at it, in the last 5 years, there have been hardly 60-70 companies which have hit the market. So our genesis of this particular product comes from the fact that on one hand you have strong flows expected. My personal view is for the next 3 to 4 years we may see close to $20-25 billion of flow, domestic and offshore put together, coming into the listed space. Second thing is last 5 years we have not seen major companies coming out for IPOs, and there is a lot of pent up demand there, especially push from private equity investors who have invested into these companies, and now their fund is coming to closure. And I think the third avenue where we clearly see is government disinvestment. Government has already announced this fiscal they would come out with between 60 and 70,000 crores of investments. So what I see is a pipeline of close to 100,000 crores of IPOs expected in the next 12 to 15 months. And on back of that, we are trying to raise close to 6,000-7,000 crores of money where it can be gainfully deployed in these opportunities.
Amit, what are you making of the Indian markets right now, which are giving up some steam compared to other emerging markets? Because you are sitting there in Singapore, how are you assessing opportunities?
Philosophically, the fund would invest into three opportunities. First is pre-IPO, which is where we are looking at companies which are at a late stage, and have plans of coming in an IPO in the next 6 to 12 months time. So that's where bulk of our investments will go. The second category, which is anchor investment, where most of the companies where we have got into pre-IPO, hopefully we would be able to get some anchor allocation also. So the first and the second category are confirmed allotment, so from that perspective, we are not kind of looking into a situation where it gets oversubscribed 100, 200 times and we're getting a fraction of it. The third channel is where we are not able to get a pre-IPO or an anchor, and if we are confident and comfortable with the company, we would look at applying it in under a QIB category, which is what the fund qualifies at, where the oversubscription numbers are reasonably lower compared to an HNI category. So these are the three broad aspects where we would be deploying our capital. We are looking at not allocating more than 12 to 15% of our fund corpus into one single company, and not owning more than 2 to 3% of the underlying investee company which we are investing in. So that's broadly the philosophy of the fund.
All right, gentlemen, both of you, thank you so much for taking time out for us. I'm afraid we'll have to leave it at that. With that, time for me to cross over to my colleague Ruchi Bhatia, who's waiting by in our New Delhi studios.